G'day and welcome to this week's video. My name is Robert Gowdy from Consortium Private Wealth, and this week I was keen to have a bit of a chat about superannuation and tax savings. Now, the saving you get in percentage term changes depending on what marginal tax rate you are currently in. So the marginal tax rates work that at the higher income you earn, you move into a different tax bracket, and they're going to change in the 2024-25 financial year. So I'll explain that one in a second. So let's hit the screen and go and have a look at what the tax rates are and have a look at what the savings in each tax rate. So we'll start at the top here. We're earning 0 to 18,200. Any superannuation that your employer pays into your fund, the tax office, the government, will refund the 15% tax that is paid for employer contributions, and that's across the board, apart when you get to $250,000 or over, where you pay 30 cents in the dollar on your superannuation contributions. So no tax there as a personal taxpayer, and you'll get any superannuation tax refunded. So we've got to remember that the super tax is 15% for the large majority of Australians. And we're comparing that to the marginal tax rate of 21, which is 19%, and also the Medicare levy of 2%. So all these numbers include Medicare. So the tax bracket that a lot of people fall in is the $45,000 up to $120,000, where you're paying 34.5 cents to the dollar tax, where you're contributing money to superannuation as a concessional contribution up to a limit of $27,500 per year, including your employer contributions. You are saving nearly 20%. So this is really attractive. For those that are earning over $120,000 per year, the saving is 24%. Between 180 and 250, it's 32%. So really attractive to max out your super contributions, particularly for those that are in higher tax brackets, as you can see. It's a different ball game once you get over 250, but if you're getting 250 per year and you're getting 11% employer contributions, you've nearly used up all your cap for that financial year. One thing to be mindful of, that in the 24-25 financial year, the tax bracket, just looking at the the 120 to 180, that will disappear completely, and what we'll have is 39% tax bracket will go, and it'll be the 34.5 cent tax bracket from $45,000 all the way up to $200,000, and that will potentially bring Aussie tax rate down in addition to that, so it'll be closer in line with the company tax. That's where most people will land, and that will give people a very healthy 19.5% tax saving, which is well worth doing. For those that are earning less than $45,000 per year, instead of saving 4%, you might be worth looking at co-contributions, where it's an after-tax contribution, not a salary sacrifice or employer contribution, but you put in $1,000 into your super, the government will give you $500 tax free into your super fund. That is a 50% return on your money. And the way that I like to think about these tax rates is that I compare it to what is the average investment rate you'd expect to earn from your investments within super or anywhere. And if you invest into the share markets over decades, then earning 10% per year is a long-term average with all the volatility in between. So if you can earn 50% via co-contributions or 19% tax saving in the 45 to 120 tax bracket, these are guaranteed percentage returns, if you like, in terms of tax saving. So they're guaranteed. These as what I always call the low-hanging fruit. So what you save depends on what you earn, and obviously with the changes we're going to see next financial year, most of us will fall into the same tax. So thank you for listening, and we'll catch you next week. See ya.